In just under a week's time, it's US election day. And for an economy that's been reeling from the COVID crisis, either continuity or a clarity of outcome is more important than who actually wins. Regardless of the victor, fiscal policy will have a big part to play in this economic future. That's the big conversation. Firstly, I'm not going to make any predictions about the election itself or the suitability of each candidate. I'm more interested in what happens to the markets. What I am going to look at is the potential outcomes under various scenarios, without saying which one of them will be the most likely. As I mentioned at the start, this election takes place under extremely unusual circumstances, with the COVID crisis still ravaging the world's economies, forcing policymakers to turn to fiscal support on a scale that many Western economies have not seen in years. That's not to say, however, that we haven't had unusual backdrops in other elections over the last 20 years. In 2000, the dot-com crisis was starting to unfold, with the Nasdaq having peaked earlier that year on its way to a decline of over 80% that would last for nearly 3 years. The 2008 election took place during the depths of the great financial crisis, which had been rumbling on for a couple of years by that stage, and then accelerated in September of 2008 with the Lehman bankruptcy and equity markets reaching their lowest levels for the year in late November. The equity market did bounce into and then decline after the election, but the tone was set by other factors. But the key difference today is that the policy response to most of the crises over the last 20 years was generally a monetary response, initially with interest rates being cut, and then after the GFC, policymakers also turned to extensive bouts of quantitative easing or QE, in which assets were also purchased, as well as interest rates being cut. Now, whilst this QE may have helped stabilise asset prices, with equities in the US and long bonds in Germany, for instance, performing particularly well, it has done little to deliver long-term economic growth. And many consider that these policies have widened the income and wealth gaps, particularly in places such as the US and the UK. In fact, many would argue that 2 decades of monetary policy have weakened economies to the point where they were unable to survive the COVID shock without direct intervention of fiscal expenditure. In many cases, these fiscal expenditures will be widening out the budget deficits and pushing up debt to GDP ratios. Now, the US is going into this election as one of those countries which has turned to significant fiscal support. Both Trump and Biden are expected to increase that support if they win the election. But the speed and size of that support could be crucial, and that will depend on the result. So for this election, I'm using 3 basic outcomes, although there's obviously many more permutations. The first is where we get a relatively known quantity of government. So for instance, Trump wins the race for the White House and the Republicans hold the Senate, maintaining the current status quo, or where Biden becomes president and the Democrats win the Senate. Now, a true clean sweep is possible where one party takes the White House, Senate and the House and therefore controls Congress. The Democrats' hold on the House suggests that they're unlikely to be dislodged at this election, though as we've seen the world over in recent years, never say never at a major election. Now, the second outcome is where we get a split result. Trump, for instance, retains the presidency, but the Democrats take the Senate, or Biden becomes the president and the Republicans hold the Senate. The third outcome should be a temporary one, or at least that's what most people will be hoping for. And this is where the election is contested, with no clear immediate winner. In 2000, the last time there was a contested election, it took over about a month for the final result to be declared. So when thinking about these outcomes, people will primarily be concerned with things like the equity market, the dollar, bond markets and gold. But in most cases, the post-election trends have already been set by the macroeconomic forces that were in play before in the preceding months. In fact, something may have to give this year. Only once in the last 100 years has an incumbent president experienced a recession in the 2 years prior to an election and been re-elected, according to Stratogas research partners. If, however, the equity market has been up in the 3 months prior to the election, they note that the incumbent was returned to office on 87% of those occasions and 100% since 1984. As of Wednesday morning, the S&P is just up over those last 3 months, so it's getting close. But as it currently stands, one of these 2 indicators might have to fail this time round. Despite the trend for the US equity market to perform well during election years, and there's only been 4 down years since 1928, the period immediately into and out of an election is affected by the level of uncertainty. When the outcome is uncertain, the S&P usually moves sideways before the big day, but once the election result is known, the equity market usually rallies as investors again start to allocate capital. 3 of the last 4 cycles saw the equity market rally in the following 3 months after the election. Only in the case of the 2008 election did the market decline, and that was in the midst of the great financial crisis. In 2000, during the last contested election, which is again considered a possibility today, the S&P did lose ground whilst Florida recounted and then Gore challenged the result. But was the equity weakness to do with the election or to do with the unravelling of the dot-com bubble? As we can see on this chart, the equity market actually rallied in the final few days of this period of uncertainty. This year, of course, we've had the exogenous shock of the COVID crisis and the swift and emphatic response from both the fiscal and monetary authorities, which have distorted price action through most of this year. Fiscal policy will continue to play a lead role regardless of who wins. But if this election is contested for a prolonged period of time, and given that the S&P is still fairly close to its all-time highs despite this week's weakness, it would come as no surprise if the S&P declined probably more than the 4% decline in 2000. This is a market that currently relies on fiscal and monetary support, although the central banks will no doubt be on standby if market weakness becomes too excessive. A contested election should hopefully be resolved, and that would take us into the other 2 broad scenarios. Now, I'm bunching together what initially appeared to be 2 wildly different scenarios, such as a clean sweep for Biden and the Democrats, or Trump and the Republicans holding both the presidency and the Senate. But that's because both these outcomes would reduce the level of uncertainty. One is an emphatic win with a clear implication, and the other maintains the status quo. The lower the level of uncertainty, the greater is the likelihood that investors will quickly return to the market. So overall equities should move higher, though the focus would be on how the US performs versus other regions. Under both scenarios, we should expect extensive fiscal packages supported by monetary policy. If the Democrats were to win the presidency plus the Senate, whilst holding on to the House, then expectations would be for a larger and a swifter support package than if the Republicans simply maintain the status quo. Ironically, a true clean sweep by either party would actually have the most similar initial outcomes because both would have equal power to grapple with the exogenous impact of COVID. Obviously, there are concerns that Biden would implement higher taxes, but again here, the impact of COVID today should delay the implementation of those policies. But what about bond yields? Could they rise if we get a clean sweep by one party or the other that leads to a swift fiscal response? There's already been a squeeze higher in long-dated yields, but central banks will be very, very wary about letting these get out of hand. Yield curve control has been discussed by the Fed. If yields started to move dramatically higher, it would destabilise risk assets, and central bankers have been trying to damp down the worst excesses of volatility. Therefore, yields could rise, but it would likely be met with a central bank policy response. Yields would underperform inflation in this environment because actual yields would be suppressed even if inflation picked up. This would push real yields lower. Lower real yields have generally been great for precious metals such as gold. If this also came with a reflationary impulse, then industrial metals would perform well, making silver look very attractive. For the US dollar, the expectations of more fiscal and monetary support, including higher budget deficits, are expected to weaken the currency. But will the US be operating in isolation? Currencies are a relative game, so whilst the policy response under both regimes could be extreme by historical standards, they may not be extreme when compared to other countries. The dollar should be weaker if there is a clean sweep, because a unified government would be able to act decisively. The underlying weakness of the economy and the ongoing issues around COVID mean that both parties would be following a similar route. If the US dollar drops, then we could expect to see foreign equities outperform the US. A weak US dollar has generally been good for the relative performance of emerging market equities, as we can see on this chart of the DXY next to the ratio of the S&P versus MSCI emerging markets. The ratio of the SPDR ETF versus the EEM looks like it might be forming a head and shoulders top, and the recent outperformance of the EEM could accelerate if the dollar drops. It's less clear-cut, however, for European equities. If US policies are truly reflationary, then European equities such as the Euro Stoxx 50 index will perform well because they are a play on global growth. If, however, the policies are reflationary primarily for the US, then Europe could struggle, as we've seen over the last few months where the Euro Stoxx 50 has underperformed the S&P 500 with the recent bout of euro strength. Therefore, I prefer to play EM equities over European equities if the dollar starts to weaken. The third scenario outlined was the one in which either Trump wins the presidency and the Democrats win the Senate, or Biden wins the presidency and the Republicans win the Senate. In both these cases, it would be a far more attritional and divided outcome. The outcome would certainly increase uncertainty and therefore the potential upside in equity markets would be muted for an extended period of time. Long bond yields should fall. Net non-commercial, also known as speculative positions, have become increasingly short in the 30-year space in anticipation of a large fiscal impulse. If there's political disunity, bonds could rally and yields could fall. And although inflation expectations may be reduced, the decline in bond yields should keep long-end real yields close to the lows. That would be another scenario in which precious metals would thrive, although the emphasis would be more on gold and silver, because the reflationary impulse which helps industrial metals would be lost, one of the reasons that silver underperformed during March's deflationary hit. If there was a gridlock on the policy response, then it would eventually have a negative impact on the economy. This would lead to a backloaded fiscal stimulus, again because of the underlying fragility of the economy. So therefore, whilst a unified government would see a swift stimulus, a gridlock could eventually lead to a bigger stimulus because of this inaction. A gridlock would be less emphatic for the US dollar. Uncertainty may weigh on the currency, but equally the lack of immediate fiscal firepower may allow other regions such as Japan and Europe to steal a march on the US in implementing additional support measures. So in summary, if there's a clean sweep, we should expect a bigger fiscal response. If the White House and the Senate spoils are shared, the fiscal response could be delayed, and this should see long-end yields fall. Maintaining the status quo, whilst divided, would maintain continuity and familiarity. If it's a contested election with no clear winner for the foreseeable future, then US assets could come under pressure as they did during some of the debt ceiling events and impasses of the last decade, where the US equity market actually underperformed other global benchmarks. But if things do start to get hairy, the US Federal Reserve will still be there to try and calm markets by capping volatility in all the asset classes. In the medium term, however, the COVID crisis will drive even a divided government to converge on similar fiscal policies. The 2020 election is still likely to be overshadowed by the impact of COVID. As discussed in the first section, it's already seen a generational shift towards fiscal policy, in which the central banks will play more of a supporting role. In fact, many think this will lead to a more extreme measure of fiscal stimulus, such as modern monetary theory and the introduction of the universal basic income, if the initial rounds of government expenditure fail to ignite real economic growth. Even in the short term, we can see how the ongoing impact of the COVID crisis continues to weigh upon the market. This week in Europe, the German DAX lost 7% by Wednesday morning, led by a near 24% fall in the tech company SAP, after it cut its sales forecast due to the effects of the pandemic, again highlighting the gulf between European and US tech names. SAP is one of the largest components of the DAX, and by far the largest component of the European tech sector. The European service sector PMIs have been dipping back into contraction territory over the last couple of months, with the Eurozone October reading coming below expectations at 46.2, having been as high as 55 in July. The US equivalent, on the other hand, beat expectations at 56. Whilst one of the focuses for this election is whether Trump and the Republicans or Biden and the Democrats will be the most active on the fiscal front, it may well be that Europe needs to return with another round of monetary and fiscal support. The next ECB meeting is Thursday, 29th of October, though most observers expect that they will be on hold until after the US election to gauge the nature of the US administration. The last ECB meeting of 2020 will be the 10th of December meeting. So far, monetary policy has had little effect on the real economy. The main impact has been on asset prices. Eurozone inflation remains very weak, with the German HICP numbers again falling into negative territory. Economies have not recovered. So far, fiscal policy has provided support, not stimulus. It has helped economies rebound, but not recover to their former levels. Until fiscal and monetary stimulus create more growth and more demand than has been lost through the pandemic period, then the short-term outlook remains disinflationary. Whilst economies may be on an upward trajectory, they are starting off from a very low base with multiple headwinds still in place. Manufacturing economies, which appear to have returned to full growth, may find there's not the end demand for their goods. This is why we should expect policymakers around the world to continue with their efforts to support a short-term rebound at the expense of efficiency. Long-term growth prospects will therefore remain subdued, so that even once the economy is seemingly fully recovered, it'll be less structurally weaker again, just like it was after the dot-com bubble and then the GFC. Turning back to the election, what would constitute a shock for the market? I don't think anything will surprise this market as readily as the election of Trump in 2016. The price action that year was far more dramatic than could be attributable to other exogenous forces. On the day after the election itself, the first move in many asset prices was a knee-jerk move lower. But once the realization kicked in that Trump and the Republicans had won a clean sweep, the markets quickly reversed. But what was even more emphatic was the outperformance of specific sectors. The mid-cap Russell 2000 index outperformed the S&P 500, whilst US equities in general outperformed emerging markets, on the expectation that Trump would now have the clout to push through policies that favoured US industry, especially domestic manufacturers. Tax cuts were also being priced in. The US dollar also rallied, with the DXY reaching its highest level of this cycle so far. This reflected the positive side of the US dollar smile, where the dollar is strong during times of strong US outperformance relative to the rest of the world. The other side of the smile is where the dollar is strong during periods of economic stress, like the end of 2015 when the global manufacturing recession was taking place. The dollar is at its weakest when there is coordinated global growth or reflation, and the higher beta currencies of EM or commodity countries tend to outperform. But what should be noted is that the Trump bump of the time only lasted a couple of months before the underlying global trends reasserted themselves. In 2017, we saw a continuation of the coordinated growth that kicked off in early 2016, when China again injected vast amounts of credit into the system. The dollar started to sag as global growth picked up. US equities performed well, but underperformed the broad-based EM equity space. So can this election create as much shock as 2016? It might be a surprise if one party achieves the clean sweep of the presidency and Congress, but that still wouldn't constitute a shock. The real shock, the pandemic, is still working its way through the global economy, and until this has been resolved, the policies of both sides are likely to be more convergent than the personalities who are vying for power. And you can now get the big conversations from Refinitiv as a flash update on your Alexa device or Google Assistant. And if you want to know more about how to download it to your smart speaker, please go to refinitiv.com/flash briefing.